Well, the end of our time in the book is here. Our last lecture. We have been talking about partnerships now for a week, the formation of them, the typical journalizing and presentation on a financial statement, and what happens when it's time to dissolve the partnership or liquidate all the assets and send the partners on their merry way. And that's what we're looking at here. And it's taking a look at, is there a capital deficiency or not? So in other words, is there not enough money to liquidate the business? Then what do you do? Okay. The formal definition of a partnership liquidation is if it ends both the legal and the economic life of the partnership for 3 reasons. Either the business is being sold, the unfortunate event of a death of one of the partners, or they're ready to file bankruptcy as a partnership. Those are the 3 most common reasons, a partnership is liquidated. Again, the sale of the business, death of a partner, or bankruptcy. To liquidate, it's actually, there's I think 4 essential steps, and they have to be done in this order as liquidation is taken a look at. First, you sell all the non-cash assets to then recognize what's called a gain or a loss on the realization. Okay, and it's called, not, like when we were selling our assets just because they were getting old, like equipment, for example, it was a gain or a loss on the sale. This one's called a gain or a loss on the realization. I know it's kind of a weird way to determine it. What are some non-cash assets? You're going to sell all your equipment. You're going to sell all of your inventory. You are going to liquidate. You hear of businesses having liquidation sales where they're literally selling the shelves that the inventory sits on. They're trying to get everything liquidated down to a pile of cash. That's the first step, and remember, we're doing it in this order. Then we're going to allocate the gain or loss on realization to each of the partners based on their income ratios. If it's a 50-50 split, they either share the gain or share the loss equally. 70-30, 5-3-2 ratio, all of that kind of stuff. Okay. So we sell everything, and then we give that to each of the partners to share based on their income ratios. Then we pay all of our debt. And then we distribute any remaining cash to the partners based on their capital balances. So whatever's sitting there left in capital, that's what they walk away from the fury or the storm. So sell non-cash assets, get them to each of the partners based on their ratios, pay all of our debts, and then whatever's left in those capital balances is what they walk away with. Remember, we can have capital deficiencies or not capital deficiencies. Boy, do you have this in your notes? Looks like it's not going to let me erase my old notes. Do you have that little form? Okay, sweet. I'll just write with a different color. ACE Company is liquidated when its general ledger shows the following assets, liabilities, and owner's equity. So we go back to the basics. Assets equal liabilities plus owner's equity, okay? Or if you don't want to put that, you can just say equals right here, okay? Cash is already cash. We're not going to do anything with that. We're going to use that pile of cash eventually, but we're going to take all of our ARs and say, knock, 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 pay, we're liquidating, we need our money. We're going to take all of our inventory, all of our equipment, minus that accumulated depreciation. We're going to take all of that, minusing that depreciation to sell it. Remember, we're selling non-cash assets. We want to convert all of that into cash. That is what liquidating means, okay? Then we're going to give them some of that. We're going to divide that $65,000 into each of the partners based on their income ratios. Then we're going to pay our bills. So this was step 1. We're going to take that $65,000 and get it to each of the partners based on their income ratios. Step 2. Step 3 is to pay off any debt. And step 4 is we're going to take any capital and send them on their merry way. Is there testing again today? I think there's testing every day. Must be. All right, so here was, is this the same company? ACE, yes. The partners of ACE agree to liquidate the partnership in the following terms. They're going to sell all their non-cash assets to another company for $75,000. That to me doesn't look like $75,000, but whatever. They decide that's what they're going to do. Then they record that gain on the liquidation. Remember, it's called a gain on the realization. Not a gain on the sale, a gain on a realization. They're going to record all the payment to all their creditors or all the debt that they owe. And then they're going to record the distribution of cash to the partners based on their capital balances. These 4 in that order. I'm sorry that all of my old notes are on here, but usually I try to delete those. So it's these 4 things, and now we're going to take it step by step. Are those in your notes as well? The little 1, the little 2, the little 3, the little 4. Okay. ACE sells the non-cash assets, AR, inventory, and equipment for $75,000. Now they had, the book value of these was $60,000. No wonder I was confused. The book value of AR was 15. The book value of inventory was 18. The book value of equipment was 35 minus accumulated depreciation. Okay. But we sold, valued at 60. We sold it for 75. Okay. So that's where you see the what we sold it for minus its book value. How much money did we make on these people or on the sale or the liquidation of this? $15,000. Okay, so we got $75,000 cash from whoever we're selling to. I can't remember. Okay. Accumulated depreciation was a contra asset that was wiped out. AR was wiped out. Inventory was wiped out. Equipment was wiped out. Okay. Normally these 3 have debit balances, but we're zeroing them out. We're zeroing them out because we're getting rid of them. Accumulated depreciation normally has a credit balance because of its contra asset nature. If we debit it, we're zeroing it out. If we take these 3 guys who typically, they're true assets that normally have debit balances, by crediting them, we're zeroing them out. So it would look like this. We've got AR. It apparently used to have a $15,000 balance. And so if we credit for $15,000, we zero it out. And the rest of it would play out. Finally, we have a gain on the realization that's appearing in red because the stuff was valued at $60,000. We just sold it for $75,000, hence the gain on realization. It's a credit because you need to treat it like revenue. It's like money in. What do you think a loss would be? A debit, it would be called loss on realization, and that would be treated kind of like an expenses cousin. Your debits and credits would not have equaled until you got that $15,000 credit in there. Because remember, we got $75,000 from that sale, and we gained an extra $15,000 based on the $60,000 lineup of those assets. Make sense? Got to go on to number 2. Remember, number 1, we're selling our non-cash assets. What are we doing in step 2? Who gets the 15 grand? Dividing it among the partners based on what? Well, their inventory, or excuse me, their based on their ratio, income ratio. There we go. So now we're going to prepare the entry of the gain on the liquidation, which is formally called the gain on realization. Remember, how much money did we make by selling our non-cash assets? 15 grand because of this. Sold them for 75. They were valued at 60. So our gain on the realization actually is getting wiped out now. Because remember, that normally had a credit balance because it's kind of like sales cousin. But we're wiping it out, and who are we giving it to? The partners. I don't know if they've ever said who the partners are. I can tell that there's 3 because we have a 3 to 2 to 1 ratio. Here, when you see it in this format, you take 3 plus 2 plus 1 and add them up. So one partner gets 3/6 or half. One partner gets 2/6. Another partner gets 1/6. So if you want to see them converted into fractions, then from a math perspective, this would of course equal 0.5 or half, and on down. Okay, so apparently we have 3 partners, and when you see it in that 3 to 2 to 1 ratio, you add them up. In this case, it's divided by 6. Then you convert it into your math. So one of the partners gets 3/6 of that 15 grand. And I don't remember. I don't even know if they told us the partner names or where those ratios came from, but here they are now. Another partner gets 2/6 of the 15,000. And the last partner gets 1/6 of the 15,000. Had it said equal split, you would have divided it by 3. Had it said a 70-30 split, you'd divide it by the correct proportions. So that was step 2. Step 1 was let's sell our non-cash assets, hopefully for a gain on the realization. Step 2 is that we're going to split up the gain based on our income ratios. What step 3 is, we liquidate. Look back in your notes. What's step 3? Yeah, we got to pay our debt, okay? So now we need to pay all of our debt to our creditors. And we had accounts payable and we had notes payable based on what was on that little breakdown of ALLO, okay? Notes payable we're going to reduce. Accounts payable we're going to reduce. Remember, they normally have credit, but they're normally credit balance accounts. So by debiting them, we're zeroing them out. If you wanted to see this from a T account perspective, notes payable was sitting there with a $15,000. If we want to get that to 0, we have to debit to wipe it out. And of course, we're going to pay cash to do so. We're going to pay cash to get rid of that. Last one. What's our last step? We're going to get cash to all of our partners. Okay. So each of these partners had little balances. 15,000, 17,800, and 1,200. But back from step 2, they each got a little chunk of that 15,000. Remember, this partner was 3/6 of the 15. This guy was 2/6. This was 1/6. Remember where we got those gains? They get a little bit more. So then they're sitting there with these final balances. Okay. and we are going to wipe out their, we're closing, we're done with this business. And so our net, we would need to debit for 22.5 to get rid of his capital account and actually hand him the cash over. That's why that cash is being reduced, because we're taking all of the money out of the business and giving it to all the owners. So you're actually wiping these capital accounts out and handing them the cash instead, and away they go. The partnership's done. So there with the P carry, we're going to do a minus 22.8, and over here minus 3,700. We're wiping them out. We're wiping them out, and then the 3 collectively equal the cash that we're going to give them instead. This was all based on no deficiency. We sold our non-cash assets for more than what they were worth, okay? Their capital accounts were in good standing. What I would like to do is exercise 12.9 right now, and then I want to show you about what if this was a loss? What if we were rocking some deficiencies? I want you to see exercise 12.9, like how we just did things with a no deficiency. If time permits, we'll talk about deficiency. There's a whole appendix section on this chapter, like talking about like specifics of a death of a partner and what that means and who gets the money and all that. We don't ever cover the appendix of a chapter. So there won't, this weekend homework is not, we're just going to go into the problem. So that's just my old one. So let's do exercise 12.9, excuse me. And if time permits, we will do the deficiencies so you can see that. What I would like you to do, and hopefully there's some room. Is there much room? So. Maybe you want to use a notebook paper. There's not a ton of room. What I want to do is the T account version so you can see where the numbers are coming from instead of just like trying to remember. So on a notebook paper, make a giant T. Under assets, make a cash T account with the plus and minus in the appropriate spot. Under liabilities, make an AP with a plus and a minus in the appropriate spot. And I just want to make sure I'm giving you the right, are we dealing with Floyd and DeWitt? Yes. Okay, good. Floyd, comma, capital. And DeWitt, comma, capital. Feels like we're going back to the basics here with a giant aloe T. So if I'm looking at 12.9, I'm on page 597 here. Data for SegWit company is presented up in 12.8. So had we done 12.8, we would have done all this, but we're just going to pull the information from there. Sedgwick company at December 31st has cash of 20 grand. So let's put that in. Okay. All non-cash assets are valued at 100 grand. Liability, okay, so let's just, we're not gonna, it doesn't even say like a breakdown of the non-cash assets, so just put non-cash assets. Not that they'd ever have a T account, that looks like this. They'd never be labeled that way, but they're saying they're valued at 100 grand. Okay. You get the idea there. We're not gonna, it doesn't tell us equipment, supplies, whatever, AR. We're just gonna make like a giant T for all of them, okay? Liabilities of 55,000. So we owe 55,000. Each partner should have a balance. Floyd is 45,000, DeWitt is 20,000. Okay, we'll come back to the liquidated. I wanted to put in their income ratios. Floyd is 60% ownership. DeWitt is 40%. Remember, you could see it in a percentage, in a fraction, or that ratio, like the last one. This would have been a, you know, well, it's a percentage, but remember if it's like the 3 to 2 to 1, you add those three up, divide it by itself, but they're giving us the percentages instead, okay? I did skip around there. The firm is liquidated and $105,000 in cash is received from the non-cash assets, okay? So did we make money? Was there a gain or a loss on the realization? Gain, okay? So maybe just write that somewhere down here. Gain on realization, $5,000 because we sold for 105 and they were valued at 100. Okay, cool. Are we set up now, ready to go? Remember, there's 4 things that need to happen in a certain order as we liquidate. I thought we'd get the story played out here, and we're going to stop after each one and journalize. Okay? They give you the order A, B, C, D. The sale of non-cash assets. Okay? Well, if we get rid of non-cash assets, I'll switch pen colors so you can see this. To get them down to nothing, we're going to say minus 100,000. We got rid of them. We wiped them out. And if you want to draw a big line through it or zero out or whatever you want to do, okay? So we have one credit of 100,000. We have plus 105 up here. Why is that 105 and this was 100? Because of the gain on the realization. Okay. We don't have that T account here. It's kind of one of those that could be a debit, could be a credit, but let's journalize what happened just now, right now. Okay, so we had a debit to cash, 105,000. We had a credit to all the assets that had an original value of 100,000. Do our debits equal our credits right now? They do not. They differ by 5 grand, of course. You can tell that it has to be a credit. And what is this credit called? Gain on what? Realization. Had the things been valued at 100,000 and we sold them for 90, our debits still wouldn't have equaled our credits, and then it would have been a loss on the realization, which would have had to be a debit. Cool? Can we move on to the next one? Come back here. The allocation of the gain or loss on the realizations to partners. So the partners get to share what money here? 100, 105, or 5? 5. Okay, they get to share the gain. They'd also have to take the loss of the hit of a loss. Okay. So we have a 60-40 split. What's 60% of $5,000? take 5,000 times 0.6, and that is what? 3. Yep. So Floyd gets $3,000, and if you want to put, gain next to that, go for it. You maybe can figure out the rest real quick. I'll just show you. DeWitt gets $2,000 from his share of the 40% of the gain. So I see 2 credits. What are we going to wipe out? It literally was this temporary thing. From a journalizing perspective, we have 2 credits. We originally had a gain. We're going to wipe that out. 0 that out and give each of the partners their share of that gain. So what you need to know is we recognize the gain and we turn around and 0 it out right away and give it to the partners. Remember, we're lots of quick turnaround here. We're zeroing. We're trying to get everything down to giving the partners cash so they can walk away into the sunset. Next transaction, what are we doing? Third step, paying our bills. We're going to pay our bills. Well, if we want this 55 to be 0, we have to debit it for 55. How do we pay our bills in a liquidation scenario? What's cash? Okay, we're wiping out AP. It's like we wiped out our non-cash assets and we used cash to do so. So you will see liabilities go down, they're wiped out to 0, and we used cash to pay them. Is there as much cash left for the partners? No, but holy cow, we had $55,000 worth of debt out there. We better pay that off. Again, we're doing it in this order. Last step, we're going to pay the partners. We're wiping out their capital accounts to pay them, okay? Well, their capital accounts do have a balance hanging, okay? Floyd had $45,000 plus he got part of the gain. DeWitt had $20,000 plus he got part of the gain. We want them to be 0. We want to wipe them out so we can turn around and say the partnership's liquidated, Floyd capital, DeWitt capital, they don't exist anymore, and here's your cash instead. Walk away with a smile on your face. Okay, so you're going to see minus 48,000 here by adding 45, the balance that he came in with the 3,000 he just gained. Okay, and this is going to be a minus 22,000. I see 2 debits. Where's the credit going to come from? Cash. Now here's the cool thing about accounting. What's our cash balance right now? 20 plus 105 minus 55. Are you fast with your math? What's our cash balance right now? 70. Does 70,000 equal 48 plus 22? It does. Okay, so these 2 credits, debit. I'm going to erase a little bit down here. Non-cash is already gone. Okay, I'm going to use, so it's sitting here with a $70,000 balance. I'm going to say minus 70,000. What that does is it wipes out cash, but it also allowed me to wipe these out. That's the kind of cool part. When you pay the partners out, that should be what's left in your cash account. So the 2 debits wiped out capital, the 1 credit wiped out cash. Who would we give the cash to in this case? Floyd the person, not Floyd Capital. And DeWitt the person, not DeWitt Capital. Because the partnership's gone. The 2 partners walked off into the sunset. My apologies if the T accounts drive you nuts or confuse you more. I guess I'm visual enough where I need to see where the numbers are coming from. Because had I said those numbers, you would have had to really follow, you would have had to know what they came in with, plus their share of capital. I guess I like the T accounts because it lets me like visualize the whole story. I do want to spend our last 15 minutes going back to the lecture. We're not going to do a problem with a deficiency, but I think it's important you see that it's not all roses. And if a partnership's going to go down, it's probably not in the positive. There's probably turmoil or distress that's happening. Maybe it's a clean-cut deal, but so let's go back and add just a little bit to the lecture. I am going to, and I shouldn't teach to the test, but here it comes. You're going to see this approach on the test with a gain on the realization and life's rosy. Okay, I want you to understand the vocabulary that goes with the deficiency. That's why I'm going to show you that. Let's see. Can I cover up liquidation of a partnership? We know that that's what we're talking about, right? But here, this is showing a capital deficiency instead. You should have this stuff in your notes as well. Can you read capital deficiency in there? Yeah, okay. ACE company, so instead of it being all rosy and we're selling our assets for more than they're worth and we all have balances, they're on the brink of bankruptcy. They sell merchandise at substantial discounts. They sell the equipment at an auction. Cash proceeds from this sale were only 42 when we knew the non-cash assets were really book valued at 100. Prepare the entry for the realization of the non-cash assets. In times of distress, you're going to do whatever you can to get some money, but you're going to give super discounts. You're going to get rid of your assets in whatever way you can. So it's still 42 grand cash. And all of the, it's the same, let's see, we've got cash. We still have that contra asset that's being wiped out. We still have these 3 assets that are being assets that are zeroed out. But we have a substantial loss instead. Do you see a loss on the realization instead? And remember, a loss is a credit. From there, they have to allocate, this should say loss, of the realization based on their income ratios, which remember was a 3 to 2 to 1 over 6. Wait a minute, where I'm not wasn't 100,000, was it? That was our problem. I want you to know where the money. Okay, there we go. I was still thinking our problem. Those assets, I want to go back just so you know where that 18 came from. Our assets were valued at $60,000. Remember, we sold them for $75,000 last time. It's hard when we jump between problems and then this. Our book value of our assets were this. We sold them for $42,000. That's where they got the $18,000. I just wanted you to be very clear on that. The hard part when we jump between. This was not the $100,000 thing. Does everyone understand where that number 18 came from? Okay, good. So the partners, there's 3 of them. The 3 to 2 to 1 split over 3 plus 2 plus 1 equals 6 divided by itself. Okay, so instead of capital going up, we're actually seeing capital go down. So we have this loss, but we got to share. In good times we share the surplus, in bad times we share the loss. And you'd think a partner that owns 50% of the business, it's awesome, but boy, you also take 50% of the hit. So they lost $18,000. Our net lost half of it. And then you see, why do they keep showing us this? Oh, okay. This is definitely a book error. Holy cow. This is a loss, not a gain. Because remember, we set the gain or loss up in the first one, and then we wipe it out and give it to the partners right away. Kind of, I like to call them my wham bams. We have it a wham, and then bam, it's wiped out in the next one. Step 3 is we liquidate our amounts owed, and so you'd see the notes payable, accounts payable, cash to cover that. Same as the last time. This is the same. Again, it's more important that you just understand the vocabulary of this. You're not going to have to do a loss. Do you have this little table in your notes? Okay, good. It's basically like a T account. Like, okay. Are we paying a partner off here, or what's going on? Let me see here. Let me go back to the chapter. Oh, I see. Here's our 3 partners. Okay. We're sitting there with a $16,000 balance in cash before the liquidation. They have capital deficiencies because they had to eat so much of the loss on the gain of, or excuse me, the loss on assets. And so each partner, you know, like at the time of liquidation, they actually are showing negative balances. Why are we paying off Eaton? Let me read this. Eaton has a capital deficiency of $1,800, so owes the partnership $1,800. Arnett and Carey have a legally enforceable claim for that amount against Eaton's personal assets. Note the distribution of cash is still made based on their deficiency or capital balances, but the amount will vary depending on how Eaton settles the deficiency. And then they like go through 2 different alternatives. This is getting really messy. And again, I want you to just see how it's all playing out. Cash is going down as we pay off all of these capital balances. If we choose, oh boy, this is really something. So I'm going to just keep reading from the book. If the partner, if a partner with a capital deficiency is unable to pay the amount that's owed, the partners with credit balances have to absorb the loss. So the people that are afloat have to absorb the loss. The partnership allocates the loss based on the amount of income ratios that exist with the partners with balances. So basically, if one of the partners can't hold up their end of the deal, the others take even more of a hit. Okay. Boy, I didn't even talk about, oh, that was the payment of the deficiency. So either the partner that with the deficiency pays their balance, or the other two partners absorb the deficiency if the one partner can't pay. This is tricky. And do you see why I like, from a learning perspective, doing the gain instead of the loss? What you need to walk away with this as you get into step 4, you're either gonna, the one partner will hold up his end of the deal and pay, or not, and the other partners will compensate for it. We are going to do problem A tomorrow in class. Let's see. We will have problem B as homework. And I'll try to model it off of, forming the partnership, sharing net income, and then and dividing the net income, and then liquidating the partnership. With a few minutes to spare, I would like you to pop back to the appendix, which you can find beginning on page 585. You would never be tested on any of this, but it's kind of interesting, I think. What happens when there's an admission of a partner? So maybe there's 2 people in business and they want to add on a third. It gives you some reading about the admission of a partner. The admission of a new partner results in a legal dissolution of the existing partnership and a beginning of the new one. So if someone shows up and says, I want to be a third partner, you actually have to see the old partnership go away and form a new one. Okay. If you go on to the next one, purchase of a partner's interest. The admission of a partner by purchase of an interest is a personal transaction between one or more existing partners and the new partner. Further on down, investment of assets in a partnership. As a new partner comes on, maybe he wants to bring in a delivery truck or certain amount of cash. Okay. Keep going, and page 589, what if a partner wants to withdraw? Now let's look at the opposite situation, the withdrawal of a partner. A partner may withdraw from a partnership voluntarily by selling his or her equity in the firm, or he or she may withdraw involuntarily by reaching mandatory retirement age or by dying. So basically, someone wants to retire. The withdrawal of a partner, like the admission of a partner, basically you have to legally dissolve it and reform it. So do you see how adding or subtracting partners, you have to wipe it out and start fresh, basically. Then if one leaves, you have to pay them for their personal assets. If you want to give a bonus to the retiring partner, there's a whole bunch of steps there, a bonus to the remaining partners. Page 591 talks specifically about the death of a partner. The death of a partner dissolves the partnership. However, partnership agreements usually contain a provision up to the surviving partners to continue operating. So it's all very important on the front end to have it all in writing and contractually set up. When a partner dies, it usually is necessary to determine the partner's equity at the date of death. So the day they died. What were they worth? This is done by determining net or income or loss to that point in the year. So what, if a partner dies in April, January, February, March, April, what have we earned for net income so far? And then they actually are going to close the books, even though it's not the end of the fiscal period. We've got to close and dump and sales into income summary, expenses into income summary, close the books, and then prepare financial statements, because basically the estate's going to get involved at this point. The surviving partners may agree to purchase the deceased partner's equity from their personal assets, or they may use the partnership assets to settle. It's all facilitated through like life insurance policies and the beneficiaries, the surviving people of the deceased partners. So life's messy, and the book writers chose to leave this as supplemental stuff, but I just wanted you to see and hear it, that adding or subtracting partners means let's dissolve and liquidate the partnership and start new. So, problem, A stuff tomorrow.